Hi, I'm Professor Suneel Maheshwari, Professor of Accounting at Indiana University of Pennsylvania. Today we'll be talking about the updates from FASB on lease accounting. Now, why the changes in the lease standards have been made? The idea was to converge the lease standards, FASB standards, with the international accounting standards. That was one of the reasons, that was the project that FASB has been working with international accounting standards for a long time. But also, the basic objective is to present in a neutral and balanced way the true economic position of the company in the balance sheet. The problem currently is that there are unrepresented obligations on the balance sheet representing the right to use asset and obligations to pay for the use of those assets. What does that mean? It basically is commonly referred to as off-balance sheet financing through leasing. In 2005, SEC has identified leasing as the largest off-balance sheet financing item at about $1.25 trillion and wanted to make sure that all the assets that have been financed off-balance sheet should be represented on the balance sheet, both the assets and the corresponding liabilities associated with those assets. The effective date for the new standards would be December 15, 2018, any fiscal years that are beginning from December 15th, 2018. Early adoption is permitted, so if you want, you can, based upon the individual situation of the company, early adoption can be used. This model is basically what we'll call a right of use model, or right to use an asset. So for any leases that are over 12 months, lessee will record a right of use of assets and a corresponding liability for the present value of the lease payment. So an asset will be recorded as well as a corresponding liability to pay that asset will be recorded. Right of use asset will be amortized over the life of the lease, and similarly, the liability will also be written down to zero. The distinction between capital and operating lease has been maintained by FASB, unlike the international accounting standards. So, the lease classification will be, from lessee's point, it's a finance lease, which we used to call capital leases. Lessor's point of view is the sales type lease. Operating leases remain same for the lessee and the lessor, although for any lease over 12 months, even for the operating lease, right to use the asset approach will be taken. Now, a finance lease has to meet any of these following criteria. If it meets any of the criteria, then it's classified as finance or sales type lease. This is very close to the capital lease classification, which is there currently in force, and where there is actual numbers to go by. But this is, as it is more in line with the international accounting standards, it is being seen that more of a principle-based approach rather than rule-based approach is being followed. So if the ownership of the asset transfers to the lessee, it is recorded as a finance or sales type lease. That is, the risk and reward, if they are transferred to the lessee for all practical purposes, then it is recorded as a finance or sales type lease. If there is a bargain purchase option at the end of the lease, that is, lessee is able to buy the asset used for a very nominal price or at a bargain price, in that case, the risk and reward of the asset are assumed to be transferred, and it is recorded as a finance or sales type lease. Then, if the lease covers the major part of the remaining economic life of the underlying asset, so that lessee is using most of the asset for most of its life, then it is classified as a finance lease. Or in this case, earlier it was 75% of the useful life, so it's just that part is taken off. In the fourth, there is, if the present value of the lease payments equals or exceeds substantially all of the fair value of the underlying asset, then it will be classified as a finance lease. Earlier it was 90% of the present value of the lease payments. In this case, it is just changed to substantially all of the fair value. The new criteria that has been, or completely new criteria that has been added, is if the underlying asset is of a specialized nature, and once the lessee has used it, no one else has an alternative use for that asset, then the lessee more or less keeps the asset. In that case, it is considered as a finance lease or a sales type lease. So if any of those criteria is met, it is recorded as a finance lease. So in this case, the basic entry to record will be right of use asset, which is debited, being an asset, so whatever that asset is at the present value, and a corresponding lease payable liability is created at the present value. The right of use asset is amortized over the life of the lease, and liability is also amortized or written down to zero during the same time. So to take an example, on January 1, Sans Serif leased a copier with the present value of $479,079, and the lease is continuing for 6 years through 2022, and the interest rate is at 10%. So in this case, we already have the present value at $479,079. If you divide that by the present value of the annuity due factor, because generally in the leases the payment starts on, it is beginning at the payments are starting at the beginning of the period, so it is you can take the present value of the annuity due factor at 10% for 6 periods given at the beginning of the year. That will be 4.7079, and that will give a annual lease payment of $100,000. So now I'll show you how to record that lease payment from year to year for the life of the asset, for the life of the lease. So the first entry recorded by the lessee is your right of use asset, and a lease liability for $479,079 is recorded. So your asset is created and the liability is created for the present value of the asset. From the lessor's point of view, the lessor creates a lease receivable as an asset for the present value, and inventory of equipment or at the lessor's cost. So basically, the lessor's inventory is going down by that asset, and a asset receivable or lease receivable is recorded for the present value. Now, when the first payment is made for $100,000, since there is no time passed, the first entire payment is lease payable to cash from lessee's point of view. So we have started to reduce the lease payable balance over here, and as far as the lessor is concerned, lessor is getting the cash against the lease receivables for $100,000. So now coming to the second lease payment, when the second lease payment is made, the total present value is reduced by that $100,000, and the 10% interest is computed on that different on the balance. So 479,079 minus 100,000 gives you $379,079. 10% on that is computed as the interest payment, interest expense, and the lease payable is that, and 100,000 is the cash that you're paying, and lease payable is basically the difference between the two. As far as the lessor is concerned, lessor is going to get $100,000 in cash, so cash is increasing, it is debited, and its lease receivable, the asset against which the cash is being collected, for $62,092, which we computed earlier, and it has an interest revenue of $37,908, which was reported as a interest expense by the lessee. If you look at the interest amortization table further, on the first date when the payment is made, $100,000 is paid, and the balance goes down to $379,079 due to the payment. In the next, by the end of the year, the interest is computed at 10% on $379,000, which is $37,908. Subtract that from $100,000 to get $62,092, and the outstanding balance will go down by the amount of $62,092 to $316,987. Now the balance is $316,987. 10% interest is computed, and the lease payable liability is going to go down by $68,301, and that goes down to $248,686. So similarly, over the life of the lease, you will complete the interest amortization table. So those would be the numbers, and the present value will come down to 0 over the life of the lease. Amortization expense was total of $479,000 on a straight line basis for 6 years. $79,845 will be recorded as an amortization expense, and by that amount, right of use asset value will go down. So now we have started to reduce the value of the asset every year, and we are also charging the amortization expense for that period. We will be making the same entry on December 31st, 2018, and end of next 5 years, the same entry is made, since we are charging the amortization at the straight line basis. Now coming to an example of operating lease, we are keeping the numbers more or less similar. So you've got a $479,079, the lease, the present value of the lease, and it will be paid in the 4 annual payments of $100,000. So in one of the differences, in the previous year it was 6 years. In this case, the lease is over 4 years, although the useful life of the equipment is 6 years. And we are making sure that the risk and reward of ownerships are not transferred. If the risk and rewards of the ownership are not transferred and any of those 5 criteria is not met, it is considered as an operating lease. But since the lease period is more than 12 months, then it is right of use asset will still be recorded. So the first entry to record a right of use asset and the corresponding lease liability at $348,685 is basically the same, similar to what we did in the capital lease or in the financing type lease. And right now, you've got the $100,000. Then you multiply it by the present value of the annuity due factor of 3.4, giving you the $348,685 as your present value. As far as lessor is concerned, there is no entry to record for receivable or to derecognize the asset. It will continue to take the depreciation expense over that period. So being the lessor, still being the owner, will continue to earn the depreciation benefit. So in the operating lease, first lease payment, your entry is lease payable to cash for $100,000. There was no interest involved. And then for the lessor, it's a lease revenue, cash to lease revenue credited for $100,000. The note that it is not recorded in the it is just recorded as a lease revenue for the lessor. Now, in the second lease payment, you got the as far as the second lease payment is concerned, again, lessor will get the cash $100,000 and it will record the lease revenue of $100,000. And not only for that, but throughout December 31st, 2018, that is over the 4 years, the same entry will be recorded by the lessor. Now, as far as the lessee is concerned, we will again compute the interest factor, interest expense. So interest expense in this case, again, whatever the outstanding balance was, or which was 348,000 minus 100,000, and on that interest is computed at 10% for 24,869. Your cash payment is 100,000. The difference between the two is the writing down the lease liability 75,131, which is also going to be the amount by which the asset is written off over a period of the lease. So then that will make the payment, then the entry for amortization to use the asset will be recorded. So amortization expense debited to the right of use of asset by 75,131. Now note over here, the total expense is coming to 100,000. You're recording in the interest expense of some 24,689, and then you're recording the amortization expense of the balance 75,000 odd. So the total expense for the lease for the lessee is 100,000 every year, and similarly, it is 100,000 of lease revenue for the lessor in an operating lease. So once you do that, then for 2009, you can prepare the interest amortization table, and again the balance will go down by $100,000. Your 10% interest is $17,355. Subtract that from 100,000 to get the 82,645 as the lease liability to be written off. And this will also be the amount of amortization that will be charged for the right of use asset. So right of use asset will go down by that amount, and this will happen over the life of the asset. Again, the lease expense will be the addition of the two, which is the interest expense and the amortization expense, and it will be recorded at 100,000 for lessee as the total expense. Now let's take go through this and see if you can choose the right answer in this. Here is Northworth Consulting that leased an equipment from Red on January 1, 2018 in an operating lease. So this is an operating lease. The present value of lease is given to you at 10% for $80,000. The 10 annual lease payments were $12,000 due at the beginning of January 1, starting beginning of January 1, 2018. The amortization of the right of use of asset for 2018 would be how much? So at the end of the year, what will be the amortization expense? Take a minute, see if you can figure that out. So if you've done it right, your choice would have been $5,200. Thank you very much for listening to the presentation. Have a nice day.